According to the latest company reports, most UK house builders are back to pre-EU referendum levels. Bovis is the only weak spot after issuing a profit warning at the end of last year. But is it all too early for these companies to rejoice, or are the foundations simply too solid? Russ Mould of AJ Bell joins me now. Hello to you. Now, let's move on to Bovis a little later on, but I think the overriding theme for these UK house builders, correct me if I'm wrong, is supply.
Yeah, well, that's in the I mean, as you said, all of their share prices are back to where they were before the referendum, although they'd actually begun to slide a good 6 or 9 months before that on fears over had house prices got too high. But yes, supply is the key problem. There's no shortage of demand right now. It's supply. Can they actually get permissions quick enough? The builders say no, they can't. It's all the regulator and the government's fault. And then can they get the whole thing through planning and build the stuff quickly to the right quality, looking at the picture behind me, which is a very important thing, because that's where Bovis fell down, as you said. We'll come back to that in a second. Mortgage application numbers did weaken going into the referendum and coming out of it. They've still been down year on year, I think 8 or 9 months in a row now. But assuming they stay flat where they are for the rest of the year at about 68,000, they'll be up 5 to 8% year on year by the fourth quarter. So on the face of it, still, yes, plenty of demand there.
And government initiatives?
Lifetime ISA, Help to Buy have definitely made a big difference there. Lots of the builders have mentioned that up to about a third of their new volumes have been Help to Buy related. So it's definitely been making a difference. You know, every little helps on a different company, but every little helps. And so, yeah, it's definitely trying to get people onto the ladder. The big challenge is, can house prices go an awful lot higher, given that people are finding it hard to get onto the ladder in the first place? The average UK house price is now about £200,000, I believe. For the quoted, it's about £250,000, by the way. The average UK income, £25,000 to £30,000. So you're looking about 6 to 7 times average salary, and yet, under the Bank of England's microprudential rules, there's only a certain percentage of bank lending that can be for mortgages where the multiple is more than 4.5 times. So that is creating a little bit, potentially, of a demand blockage, as it were. So that's something to keep an eye on.
But house prices have come down a smidgen.
Yes, which I think, if you're looking, is fantastic news. If you're a Daily Mail reader, it'll probably have you frothing over your cornflakes on a morning. But if you're a buyer, it's exactly what you want to see. You need a chance to get onto the ladder. And so, yeah, I would think that prices can probably only go so far realistically, again, given the Bank of England is doing its best to a degree to limit mortgage availability on, you know, very, very high income ratios for mortgages, for example.
Why Bovis? Why is this the standout weak spot?
Self-inflicted wound. If you look at the company's report and accounts, management bonuses were triggered by earnings per share. And so, generally speaking, I think they cut some corners. They actually disbanded their crews over the summer to keep the costs down, couldn't get them back quickly enough, then tried to get everything cobbled together very quickly at the end of the year. There were quality problems, so there's lots of unhappy customers there. The chief executive who oversaw that, he's now gone. The company's looking for a new CEO. So what you have with Bovis is a company with a terrific land bank, quite southeast focused, trading on a very low multiple of book value, which is why Redrow and Galliford Try have both sniffed around a little bit. The new CEO's first job, he or she, their priority is going to be keeping the existing customers happy, those who were sold properties that they're not happy with, and then making sure that build quality going forwards is exactly as it should be. And then, if he can or she can do that, Bovis is potentially the cheapest stock of the lot on asset value basis.
Okay, so a bit of damage control, then you could potentially get a bargain.
Potentially so, yeah. I mean, it's the most expensive on earnings because the earnings are depressed because it's made an absolute hash of things. Its operating margin is only 15%. The group average is north of 20%. So if they can get their margins up to peer group level, it'll be pretty cheap on earnings and cheap on book value. But yeah, you've got to have faith in A, the management team's ability to turn that around, and B, obviously you don't want to see the overall housing cycle tip over for whatever reason that would be, whether it's prices are too high or Brexit or whatever else it happens to be.
Well, let's pick up on that then, Brexit, because if you are invested in any one of these companies, what should you be watching out for? What a potential
Brexit-wise, I mean, in the end, people need somewhere to live. I'm not sure Brexit's going to make a colossal amount of difference to that. And if anything, the pound going down has probably made UK property cheaper to overseas buyers, which again has possibly created a bit of an underpinning. And if you look at what actually drives the builder share prices, mortgage approvals, house prices are absolutely massive. That assumes they don't make a mess of building the things, obviously, so you've got to almost take that as granted, but Bovis got it wrong. But in the end, if they're doing their job properly, those are the things that really drive them. From a share price perspective, the yields on these things are really quite high. They've got generally net cash balance sheets or very limited debt. Barclay, Barratt, Persimmon have got share buyback schemes or cash redistribution schemes, which put these stocks on very big yields, almost up where their earnings multiples are. So in the face of it, they're cheap. Why is that? Because people are worried from an investment perspective what Brexit might mean, and if house prices do slow off and volumes can only grow so quickly and cost pressures start to creep up, are you reaching a point whereby margins are topping out? So there are still a few moving parts to keep an eye on there.
Okay, but the foundations are solid.
On the face of it, demand is incredibly strong and it's currently outstripping supply, which seems like a pretty fair starting point, yes.
All right, Russ Mould, we'll leave it there. Thank you very much indeed. Talking about the UK house builders today. Thank you for watching.